In this current environment, I think the key is not to have a strong exchange rate. We are undervalued on the rand front. It's not necessarily such a bad thing when global trade is down. You actually want to be as competitive as possible.
Yes, it's time for Coffee Break Commerce, your business and forex audio fix created by Absa Corporate and Investment Banking. Joining us is Mike Keenan, Principal and Head of Fixed Income and Currency Strategy for Absa. Welcome back, Mike.
Thanks, Justine. Good to be back on the show.
So talk to us a bit about the current account deficit. First of all, what a current account deficit is, and then where we are in South Africa in terms of also the exchange rate and their impact on one another.
Absolutely. So the current account consists of two key components. One is your net trade, so that's your imports versus your exports. So whatever that net balance is gives you your trade balance. If you export in more than you import in, you will run a trade surplus. In South Africa's case, we normally run trade deficits, and that's because up until earlier this year, oil prices were running at much higher levels than sort of metal prices. We import a lot of oil, we export a lot of metal and precious metal commodities. So that's why South Africa often has a trade deficit. And the other big component of the current account is the coupon and the dividend payments that we have to pay to foreign investors. So for the past decade, foreign investors have really bought a lot of South African financial assets, whether it's equities or bonds. And that's great because the capital comes into the country, but those investors then actually take money out when they get their dividends or their coupons. So that's the outflow. And that actually is normally a bigger driver of the overall current account deficit than even the trade flows. That's always important when you think about the rand. The rand, according to our analysis, is driven predominantly by capital flows. About 2/3 of average daily rand turnover is driven by capital flows, and the remaining third is driven by trade flows. So those dividend and coupon payments are really a significant driver. And when you've got that current account in a deficit, it means that you have to attract more and more capital inflows. So foreigners have to keep on buying your equities, keep on buying your bonds, or your currency has got to weaken so that your trade balance improves and compensates it. So there's a lot of moving parts, but essentially the lower the current account deficit, the better for the currency. And the larger the deficit, the more the currency needs to weaken. And we were running current account deficits of about 6% a few years back. We think the current account deficit is going to basically be flat this year. So very rand positive.
Let's just talk about the fact that South Africa has taken on foreign loans. And I mean, that obviously is going to have an impact on the current account and the local situation. Tell us more about what this means.
So from a sentiment perspective, I think it is positive that South Africa is starting to source some of its debt more and more from abroad. I think it spreads the portfolio of debt a little bit more widespread, which is not necessarily a bad thing. I think also the fact that some of these loans come with terms and conditions also helps the currency because it might require the local authorities to conform to some structural reform. But in actual practice, in terms of the hard flows, we at ABSA believe that will actually be more rand neutral, because probably what is going to happen is when the dollars come into the country, it's not going to come through the normal foreign exchange market. It's going to circumvent that market and go directly into the Reserve Bank's coffers, and it will be used to build reserves, so it won't touch the spot market. And then the Reserve Bank will basically print essentially rand to give to governments, who is then going to use those IMF loans to help on the pandemic front and roll out things like hospital expenditure, etc. When that rand then goes into the system, the Reserve Bank will want to caution against that money stoking any kind of inflation, so they will sterilize that money through things like FX swaps, debentures, and those kind of open market operations. And the nice thing about doing an FX swap is that on the one hand, you actually curtail any inflationary risks, but at the same time, you prevent the rand from strengthening. In this current environment, I think the key is not to have a strong exchange rate. We are undervalued on the rand front. It's not necessarily such a bad thing when global trade is down. You actually want to be as competitive as possible. So the Reserve Bank has got no desire for the rand to suddenly strengthen dramatically. It actually helps, and they can tolerate a slightly weaker rand at the moment because inflation is so subdued. So yes, we think it's going to be more neutral in practical terms, but from a sentiment perspective, there could be a little bit of positivity that comes through. But I suspect that positivity probably came through when the loans were initially announced, which was a good few months ago. So I don't expect any further rand strength from these loans.
Does that have any currency impact, the fact that South Africa is more in debt on a much larger scale?
Well, the nice thing about doing things like FX swaps without getting too technical is that there's two legs to an FX swap. The first leg is those dollars that came in from the IMF. They will be sold for rands in the spot market. So initially, they will be sold, which then, all things equal, you would say, well, that's got to be rand positive. The thing is, there's a second leg to that transaction, which is done simultaneously, which is then involves the agreement at the time to buy those dollars back at a predetermined exchange rate. So like any corporate that's got foreign exchange exposure, if he knows that in 6 months' time, a year's time, 2 years' time, he needs to buy something from abroad, he can actually lock in that exchange rate today, as long as he's got an underlying commitment that that transaction will take place. And there's definitely an underlying commitment here between the IMF and South Africa. So whenever these guys agree, those dollars will be bought back at an exchange rate that's already known today. So the exchange rate risk is limited. Of course, there's a cost involved with that. Any hedging, any insurance policy that anyone takes out, there is a premium to be paid. But I think that's a premium that anyone is willing to take that wants to make sure that you don't, like you suggest, end up with this huge bill 5 years down the line when you've got to pay the IMF and maybe the rand is a lot weaker than it is today. So they are managing that exchange rate risk through those kind of mechanisms. And at the same time, the beauty about that instrument is that you also are taking rand out of the system. So you're preventing it from becoming inflationary. So when they sell those dollars for rands in the spot leg, the first leg of that transaction, they drain any excess money floating around the system straight away. So it's killing two birds with one stone, really.
Tell us what all of this means for our listeners.
So, we are the most bullish house on the rand at present. Our forecasts are also well below the forward curve. In other words, the cost of hedging yourself against any kind of currency risk. Our rates are well below where those hedging costs are sitting. So for us, for clients that are export orientated, we think the rand is going to get stronger from here. Those clients should actually be taking advantage of the weak exchange rate environment to bring some of those dollars home, convert them into rands, and facilitate their local operations. The importer clients, on the other hand, we think they must be careful about not panicking in the current environment. We know the news flow is bad, but we don't think you should be going out and buying dollars in this current environment. We think you will get better levels to buy your dollars, as I say, end of the year, first quarter of next year. And that's why for those clients, we think it's better to wait as long as possible before you actually buy hard currency.
It's been really interesting. I'm so glad to have had these insights with you. And that's all, I think, for today's Coffee Break Commerce, created for you by Absa Corporate and Investment Banking. Thank you, Mike Keenan, for your insights, and thank you, listeners, for joining the conversation. Please do talk to us and send us your thoughts and FX questions to internationalbankingservices@absa.co.za. Let us know what questions you'd like future podcasts to focus on, and please share this episode with interested friends or colleagues. Join us next time for another Coffee Break Commerce.